Well, thank you, Marcus. Incredible stuff. Isn't that insane? Well, you guys want to know, obviously, what that means for numbers, how all of that, what you heard, before comes together, and maybe what we're doing on the cost side. Before doing that, however, I would like to share just this slide with you here. As very important is that we share what are the assumptions on which we look into the future. And I would say, you can read that yourselves, from the chart, but in overall, we take a prudent view when we look at the macro and the market evolution looking forward. That is baked into the statements we're going to make here with regard to the outlook. What does it mean all in all? How does that translate into our expectation for sales moving forward? Stable level, in Europe, good momentum, solid momentum for the US, cautious view on China, and overall, obviously, risk of tariffs is not something which probably in terms of overall economy is going to help, but I don't want to speculate on that much further at this juncture here. Now let's dig a bit deeper and see how this incredible portfolio firework to come is going to impact sales and mix moving forward. On the sales side, we depart in 2024 from a bit less than 2 million, as we heard earlier today. 2025, we take a more cautious view for the reasons just outlined, and as you heard in the guidance this morning. But clearly, isn't there a point that this incredible portfolio firework is going to generate momentum in 2027? Don't you think there is something in it with what you saw last night, what you see here this morning, and what you're going to see this afternoon? I strongly believe in that. I very strongly believe in that. What does it mean for the mix? On the top end side, we target a share between 14 and 15% for the time to come. Definitely the S-Class upgrade Ola had been talking about is a very, very strong driver in this respect. But think about the AMG you saw last night, the beautiful CLE you could see, but also the AMG EA, so on the EV as well on the ICE side. What does it mean for the XEV share moving forward? Well, we expect that to increase from 2026 onwards, obviously when the CLA and the MMA is going to ramp, but then, as Ola pointed out, in particular when the electric GLC and C-Class are going to hit the road. So that is going to generate significant momentum on the EV side. Next to it, we have that very strong plug-in portfolio where we see solid demand for that. And I think that is an additional opportunity which can be leveraged. So all in all, we do expect that the XEV share should therefore go up to more than 30% in 2027. Obviously, I need to say that finally that depends on market conditions, on infrastructure availability, as well as on customer demand. What does it mean for the top line? We are very much focused on the sales numbers all the time, but sometimes we don't look so much on the revenue lines, if I may say. Well, I dare to look back for a second, 2019, 2024, where we all see sales down. Well, if I look into the revenue, thanks to the mix and the pricing, actually I find a CAGR of 2.5% between 2019 and 2024. What does it mean looking forward? Yeah, we want to drive a solid top line as well. What's driving that? Definitely ASP and pricing. And yes, it's a super competitive environment, but we want to stay disciplined. The strategy in terms of value over volume is in place. It has not been abandoned. However, it is a more competitive space as it was some time ago. So we will be competitive in the market, but we stay disciplined on the pricing side. What does it mean for the revenue evolution? Well, obviously, for 2025 and 2026, revenue cannot disconnect from sales evolution, as we heard earlier. But again, 2027, with a product momentum, that should allow to support the revenue expansion moving forward. Now, probably a question you also have, what does it mean, all of these products, this gigantic portfolio, 40 positions in terms of the margin? What can you extract as a juice, as a margin out of it? I'm happy to elaborate a bit on this one. Yeah? So let's get started with the top end. So these are truly, iconic products, aren't they? And I would say as high as the standard and the quality and the excellence of these products are, as high is the margin of these products. And when I stand here, I'm happy to say that with around 280,000 units we had in the top end in 2024, this contributed to more than 40% of the contribution margin of cars in 2024. And now just think a second about what is to come with the AMG EA, with the ICE lineup, with the S-Class. So don't you think that there's a bit of potential that this 280 could be a higher number moving forward, call it 300 or so? And the margin quality I was just talking about, so isn't that a significant potential in the lever moving forward? Up to you. I look at the core side. I would call it a healthy contribution. Well, what's that? That's more than 1 million units, E-Class, a roaring success in the market. And I can say it's a very healthy contribution margin we're printing in that segment, not only on the E-Class, in that whole segment. So it also contributes approximately 40% to the contribution margin overall of passenger cars. And same thing here. You heard electric E-Class, electric GLC, electric C-Class, to come. So definitely, I think there is a potential for expansion on the volume, but also with healthy margins in that segment. Now on the entry, you have a lot of questions. Is that dilutive? No, in my view, it's not. This is a solid margin contribution in the entry, and I would call it an accretive contribution margin quality. This is around the 500,000 segment, and with CLA, MMA, we're elevating them in the game in terms of value proposition, and therefore we also have the intent to retain that solid margin in the entry segment moving forward. Your other key question, obviously, is with a higher share of the EVs, what does it mean in terms of the margin for the portfolio? And how can you create or improve, the margin on the EV side? Well, I think you heard, the number one answer before. It is all about the product. The EV product needs to be at least as good as the ICE product. I'm 200% convinced of that one. And you will see it, this afternoon in the driving experience, and you will see it, also in the products, later today. Can you close the margin gap on the top line, on the pricing side? I think we all learned that the hard way. No, you cannot. So what can you do? Again, do the right product and get the cost right. So what are we doing here? We take the EV cost down by more than 15% over the predecessor versions of the respective EV products. And that means we can narrow the gap between the ICE and the EVs in the future. At the same time, we also know, and you heard it, with the portfolio expansion on the ICE products, that ICE is going higher for longer. Isn't that great news? I think so. So in terms of the certainty of driving the margin, I think we might have lost a bit sight of that one, that this is, compared to some time ago, where there was the view of a much higher EV share, I think it's good news. Where is our emphasis going in terms of the investment focus? So I can say coming to investments later, but at this juncture, as we're talking about the margin in the portfolio, it's already today more than 70% of the investments going into the top end and into the core. And I think it will rather go up moving forward. And elevating the portfolio overall, not just in top end, but within the entry, within the core, and for sure, the top end overall, this is a very, very important and significant mitigant to a higher EV share moving forward. Maybe so far here on the top line side, on the portfolio, but obviously very important that we're laser focused on cost and efficiencies, and we have come a long way on that, I would say. But we're switching gears, we're stepping up, and that's why we created the Next Level Performance Program, NLP, to boost competitiveness and resilience even further than that. So let's jump into that a bit. And obviously, the first thing you need to talk about that is what is your industrial capacity? Ola, when you mentioned adjusting your suit to your body size. Yeah? And what did we do here? Over the last years, we adjusted already. We adjusted to end 24, I would say around 2.5 million units capacity worldwide. You have that on the map. That is a map by the end of 2024. And we did that by divestment in France and Russia and Brazil and Indonesia. What are we doing moving forward? We will further right size. So in the 3 years to come, basically we'll adjust the capacity to around 2 to 2.2 million units. How can we do that? We'll lower capacity by around 100,000 units in Germany. We'll increase and shift capacity to Kecskemét in Hungary for around 200,000 units. We'll end the GLB production in Mexico by the end of 2026. We have optionality in remote locations, and we have optionality for around 200,000 units in China. And a testimony that we're serious about it is, I think, just the announcement which was made yesterday in terms of the divestment from the van plant in Argentina. So we are serious about it. What does it mean in terms of plants in Germany, as there's so much talk about it? No, we have no intent to shut down an MB plant in Germany. We will limit the capacity of the German plants to around 300,000 units each. So how can we do that? We adjust the workforce. We adjust the workforce via attrition and temporary workforce cuts. So clearly, the target is to adjust the capacity to around 2.2, and at the same time, we retain flexibility in line with the portfolio evolution, expansion, as market conditions will tell us. And obviously retain the flexibility we're having already today between ICE and EV in the respective facilities. Next to capacity, let's talk about production cost. How can we attack production cost? Well, I'm happy to say that over the last 2 years, basically, we reduced production costs since 2022 by 10%. So we target now an additional 10% production cost reduction between here and 2027. And we will not rest there. We aim to double that number until the end of the decade. So you might wonder, how does that work? What are the levers? So, the first lever is moving east. I already mentioned before that we're stepping up the capacity in our factory in Hungary, in Kecskemét. And that means that the share of low-cost country in the EU will go from 15% to 30% by 2027. And why is that so favorable? Well, I'm happy to say that the factor cost in that facility in Kecskemét are 70% lower than in Germany. And we also will shift one product in the core segment to that facility in Kecskemét in the future. What are additional levers on the production cost? Well, we are on the path to reduce headcount in Germany through attrition. We'll step up the accountability for efficiency measures and competitiveness at the plant level, reduce absenteeism, something which has been talked about quite a lot in recent days. We'll step up production planning, digitalization, more use of AI, for example, in the end-line quality control, into the digital twins, everything. But also reach out to logistics, review that, transportation routes, and also attack the energy cost by the use of more renewables, such as wind park in northern Germany and photovoltaic on the roofs of our industrial facility. So all levers are being pulled here on the production cost. Now, let's have a look at our geopolitical hedge. So in particular important when it comes to the tariff discussion, obviously. So this is not something which is completely brand new to us, as a philosophy of going local for local is already well embedded into the company. So what's our target here? From 60% in terms of local for local, we want to go to 70% local for local. And we can do that, obviously, by further localization of products into China, as well as the option into the US. Let's have a bit closer look in terms of what makes these facilities and these homes so special. So clearly the US is the home of our SUVs in Tuscaloosa, Alabama, with around 250 to 300,000 units being produced locally over there, of which 2/3 get exported. It means that the trade balance on the vehicle level is roughly balanced, and we're one of the major exporter of vehicles from the US. And in the midterm, it means from that facility, from the US, we're going to export top-end vehicles, top-end vehicle SUVs to China, and we'll export from the US top-end and core SUVs to Europe and the overseas. And we have the potential to localize an additional product from the core segment into the US, into Alabama, into Tuscaloosa, Alabama. How does it look for Europe? Europe, I would say, basically call it the home of the top end, the kind of reference, the symbol of craftsmanship and excellence, with around 80% of the market being served locally. And obviously here the exports go mainly from Germany to top end into China, and the top ends and the sedans also to US and the rest of the world. China, a very strong local presence there with a BBAC, our GV jointly with our partner Bike, that serves around 80% of the market locally, and by mid-2026 we will localize the long wheelbase GLE for the Chinese market into China, but we are not doing any exports from China. Next chapter on efficiency, obviously, is material cost. So what is our target here? We want to reduce material cost by 8% until 2027. What are the key levers here? That's our BEAT program. BEAT 2026, Markus, which you launched with Gunnar. And here clearly we do expect each and every supplier to be laser focused to pull all levers to reduce material costs. And I would say we got already very good traction in 2024. I talked that morning about the industrial performance. So you can see, in there. But let me be clear, this is not, I think, in the spirit of a classical, conventional beat the supplier program. It is a cooperative approach. So we bring the engineering and the procurement teams from Mercedes together with the respective teams of the suppliers to challenge design, to challenge specification, to work on higher level of standardization, to work on technical refinement, push design to cost initiatives jointly with the suppliers. Lever number 2 is, you heard it from Markus, is a reduction of the battery cost. 30% reduction of the battery cost on MMA with the levers, through chemistry, LFP, through the economies of scale where we're doing here, the design and the sourcing as well on the battery side. Third lever on material cost is to reduce one-timers. And that's why we started to introduce new flexibility approach, new flex rates into the contracts. That should better shield us against idle cost risk in the future and should also support a decrease of one-time cost in the future. Fourth lever, we're talking very much about production material, but there's a little bill which is called non-production material, which is just 20 billion. So lots of opportunity to work on that one as well. How? Demand management, specification, renegotiating contracts in this area, leveraging automation, AI, outsourcing. So great potential in the non-production field. At the same time, however, let me be very clear, and you see it on the bottom of this chart, we will continue to step up the content of the vehicles to meet regulatory requirements, but as well to step up further the competitiveness of the vehicles. Now on the investment side, I would say we are disciplined, very disciplined on the investment side. You can judge it yourself if you look at what has been achieved between 2019 and 2024 by the investments globally being down 8%, net of inflation. But what's more important, obviously, is looking forward. So what does it mean in terms of the investment profile ahead of us? For 2025, we do expect the overall investment to go up by approximately $1 billion to support the product launches you heard this morning, last night, you will see later today. But then from 2026 onwards, or from 2026, or in 2026, we expect this investment already to go over the peak and start to come down. And that means for 2027, we target an investment level of around 10% below the 2024 level. Or in other words, 20% down compared to 2019. And that is exactly what we promised back in the day, a couple of years ago, despite all of the changes we did see in the landscape. Now your question is going to be, how can you do that if you do all of these products? Well, let me wrap that up. The investments in M&A, in MMA, into electric GLC, into C-Class, into AMG EA, they will be more or less completed by 2027, and we are already beyond the investment peak for these vehicles. We will obviously ramp up investments for future products to come when it comes to next generation S-Class, to E-Class, next generation SUV. I think that's inherent with the business. But what you heard from Markus in terms of modularization concept, be it on software side or be it on hardware side, we can leverage throughout the entire portfolio of ICE and EVs. And this efficiency of scale will allow us to reduce investment. And the efficiency Markus showed on the chart, if you follow that closely, on the powertrain side, on the ICE variants, compared to what was there in the past and what is going to be in the future is much more focused, as well as on the EV powertrain side is much more focused, and you can use it and scale it throughout the entire portfolio, be it from the entry into the core, even into the top end. And that is a fundamental lever to bring the investments down on that journey to meet the profile I mentioned before. At the same time, obviously, we'll keep investing into the tech stack, as you heard, on MBUS, as well as on other technology bricks. Fixed cost. Well, didn't we say in 2020 that we would bring fixed costs down by 20% 2019 to 2025? Yes, we did say that. So we achieved 19% by the end of 2024, as you heard earlier, that morning. Just bear in mind that the inflation rates, as per my stats or maths, in Europe and Germany were more than 20% during that period, or call it 30%, worldwide. So I think it gives you an idea of the effort being made and accomplished during that period. But obviously, we'll not rest there and feel good with that. No, we'll take it to next level. So we're going for the next 10% of fixed cost reduction. So you might wonder, how is that going to work? Well, what are the levers over here? We will reduce the active workforce via attrition, but also via voluntary redundancies. We have still, I think, significant outsourcing potentials, which are working upon in finance area, in HR, in general procurement, lots of other areas. We'll definitely streamline business functions. And you saw it on Ola's slide that morning, and you might have heard about, such as bringing our mobility business closer to the marketing and sales teams, integrating them. Or the announcement we made some time ago on the divestment on our own retail business in Germany. We're taking management positions. We're increasing the span of control. We're reducing the layers, and we'll change team management to a more flexible approach. And we stop doing non-essential activities. We standardize, we digitalize, and I think there's a great potential in terms of using much more Gen AI throughout the entire business. Maybe, Christina, we're doing the next disclosure call with the support of that, and you have a robot in front of you. Yeah. So let's come back to China shortly. We're definitely starting from a position of strength. What has been achieved over the last decade in terms of market position, I think, is outstanding. How does it look like for the top end in 2024 in China? As we talk so much about it that sometimes we forget what is the absolute position. So clearly, we're holding more than 50% of the market share in the top end, above 1.5 million renminbi in China. Clearly, we're the number one position when it's above 800,000 renminbi. On the AMG side, we're number one in performance in this market. The S-Class, despite everything you read, you talk, is outselling the competition by the factor 2 to 3. And if you look on the chart, you will see that we have the highest MSRP among premium OEMs. What is not on the chart is that we have the lowest discount among these premium OEMs. So the highest MSRP, the lower discount of all of them. And that just means that the brand still has incredible pricing power in the market. However, I don't want to stand here and be naive. We're fully conscious of the challenges we're facing in the market and the need to be competitive. But we're clearly geared to defend that top-end market position and to protect our profit pools in China. So you heard it in terms of what is the strategy. Focus on what makes a Mercedes a Mercedes, and that applies in particular, I would say, in China, where the brand still has a very, very strong position. It is important to return to the iconic and the status-driven design, to push the dedicated China products, such as the GLE long wheelbase, the S-Class upgrade, the dedication to the rear, but obviously also to be on cutting-edge technology forefront. Let me say a word maybe on the local production, on the GV, on the BBEC side, also to put a bit of facts and figures here. Yeah. So despite the contribution from BBEC coming down in 2024, as you could see earlier on the EBIT walk, I would like to share with you that the return on sales of that entity is a 15% return on sales. Isn't that damn healthy? What's our challenge? What's our target? What's our mission? Obviously, it is meant to right-size the GV, the BBEC, in such a way that it can retain double-digit margins also in the future. And for that very purpose, we launched jointly with our partner a very, very comprehensive cost reduction program. And what does it mean? It attacks material costs by more than 10%, deeper localization, efficiencies, technical efficiencies, renegotiation of contracts. It addresses as well, the variable production cost, and it also addresses, the fixed cost by more than 20% respectively. So a very, very comprehensive program. But there are also additional measures. I alluded to adjustment of industrial capacity before. I would mention also that on the dealer side, jointly, we're looking at the network evolution to make it efficient and adapt it to the size, to the market, the demand. The GLE localization offers cost opportunity, cost advantage in China, and will obviously expand the footprint also for the China fit products on the R&C side and capture opportunities there in terms of development cost. Now, let's switch gears in terms of what does it all mean for the financial framing. And I understand there were some bets out whether there's going to be a weather chart or an update of the weather chart or not. I don't know whether you call that a weather chart or an outlook. Frankly, I don't care. We feel that in an environment which is pretty demanding and volatile, probably putting out a weather chart doesn't make too much of a sense. But let's stop that debate, I would say. Let's just look on what it is. So here it is. It is a clear roadmap back to double-digit margin. Important to note in there, and it's a reminder, that I think we take, in this respect, a prudent macro and market perspective, as I showed on the first chart of that deck here. I do believe it is fair to assume that the product firework is going to generate momentum on sales and revenues more towards 2027, as I emphasized them before. You heard that we're very focused on narrowing the gap in terms of margin between ICE and EVs by hard cost work. Clearly, everything I said in terms of NLP, so next level performance, when it comes to reduction of production cost, material cost, the fixed cost, and investment down, is built into that. And when, I'm sure you're going to ask me that, so I preempt it. When you're going to ask me, so what is the biggest lever when you come from 2024 to that double digit in 2027, I can tell you it is the NLP side. It is what is in our hands in terms of driving cost and efficiency. I would like to remind you, obviously, what I said on the guidance, that any incremental tariffs are not included in these outlooks, as mentioned for the guidance, also applies here for the other years to come. Margin is nice, cash is a reality, you know that better than me. So what does all of that mean in terms of cash generation and return to you? Well, I think we have a little track record here on the chart. So between 2019 and 2024, we generated more than 45 billion euro of cash flow industrial. We distributed around 30 billion via divvy and share buyback. You got on top 65% of the Daimler Truck shares via the spin in 2021. And if you wrap that up, that's a total TSR between 2019 and 2024 of 100%. Let me illustrate that with a little maths here. Let's assume you bought 2 Daimler shares in 2019 at a share price of 50 euro. Make it simple. So you invested 100 euro at the point in time. And let's assume you still hold the shares today, right? And let's assume you're still holding the 1 Daimler Truck share you got via the spin. And you count what you got as cash dividend. And obviously, the accretion effect from the share buyback helped as well. So if I do the maths, I come up with 200 euro. So despite all of the difficulties in 2024 and in industry, isn't that interesting? 100 euro invested in 2019, 200 euro today, if you still hold it. And I'm pretty sure keeping it is a good idea, or doing even more. At the same time, the NIL went up from 11 billion in 2019 to 31 billion by the end of 2024. But, well, so far that is looking a bit into the mirror. But now, what does it mean in terms of looking forward? What does it mean in terms of the capital allocation and the capital allocation framework moving forward? You can take for granted we are committed to shareholder returns. And we're committed to shareholder returns as you expect them, but we're also committed to them as it is an expression of our own confidence into our future operational and financial performance. And that's why we will continue to use the cash flow after divvy for share buyback moving forward, at the same time retaining a very strong balance sheet. What's a concrete capital allocation proposal now, which we want to share here today? It is a divvy for 2024 of €4.30 with a payout around 41%, in line with the framework. We want to announce also here today that we will continue our share buyback activity. The supervisory board decided yesterday to launch a new buyback program of up to 5 billion over 2 years, up to 2 years, starting potentially in May 2025, as we need to seek the approval of the AGM for 10% authorization by corporate law in May 2025. And that 5 billion share buyback program is intended to be supported by the cash we will generate in 2025 and 2026, and the beginning of monetarization of the Daimler Truck stake. At the same time, protecting a very healthy NIL level. A word on the Daimler Truck stake. You know the lockup expired by the end of the year. We see the potential for some monetization of cautious stakes. We see that, I mean, the stock gained significant traction on Daimler Truck side since the spin-off, more than 30%. You know that I do see there is further potential in it. We clearly mentioned that we see that holding as non-strategic, and therefore I think it's just a logical step that we will consider monetization of market of a share over time in market-friendly way. And these proceeds are embedded in the cash flow and the 5 billion program. Again, important that we need to seek authorization from the AGM for doing that. Well, I think it's time to wrap it up and maybe sum it up in terms of what are the key pillars of the equity story of that company. Why is Mercedes unique and stands out compared to others from your perspective? That ultimately remains your perspective, but I'd like to offer, I mean, our perspective. We do consider Mercedes is a unique blend of luxury and cutting-edge technology. It's the most valuable brand with iconic products, and that means it captures the hearts and not only the minds of customers, it makes them go irrational. The people at Mercedes are committed to excellence and innovation. Since the creation of the company, you could even say they inherited that from the founders. And the product evolution, the product firework we're talking about here today, I think is just taking it to another level. But with exactly that the DNA. And you see, I think, a very Swabian discipline at work when it comes to cost and investment, laying out the roadmap back to double-digit margin, continued cash generation, a solid balance sheet with 30 billion, which provides a lot of flexibility and opportunities, with a benchmark capital allocation framework, which we honor and are committed to with the announcement we're making here today. Obviously, our job is to deliver. The investment decision is yours. Thank you.
Thank you very much, everyone. Thank you very much, Ola, Markus, and Harald, for your presentations.